Welcome everyone to this webinar, a highly topical subject entitled The Duration Trap, Navigating Hidden Risks in Risk-Free Investments. A bit of our housekeeping to start with. The session will run for no longer than 30 minutes. At the end of the session, we will do a question and answer session. There's a Q&A box at the bottom of your screen. If you want to pop any questions in there as we go, we will do our best to answer them all. If we do run out of time, we will endeavour to get back to everyone after the Zoom. So don't worry if we don't have time for all the questions. Let's kick off with a brief intro to Clive Corcoran. I've worked with Clive for over 15 years, and it's always a real pleasure to introduce him. With more than 30 years experience in finance and investments across both sides of the Atlantic, Clive brings a wealth of knowledge and insight. In recent years, he's focused heavily on risk management, writing several respected books and delivering executive education all around the world. His work spans banking, insurance, energy, and sovereign wealth funds. Clive has delivered training for some of the biggest names in finance, including Bank of England, UK Treasury, the European Central Bank, European Commission, CME Group, Goldman Sachs Asset Management, Kuwaiti Sovereign Wealth Fund, and Emirates MBD Bank, amongst loads of others. He's got a real gift for making complex topics clear and engaging, so I'm really looking forward to our session today. Over to you, Clive.
Well, thank you for that introduction, Taya. Very kind words. And hello to all the people on the call. I gather we have quite a number of people from different parts of the world, parts of Asia, parts of Europe, and so on. So let's jump straight into the topic. And as you can see on the screen, there aren't too many slides, by the way. I want this very much to be a kind of a free-form discussion. I welcome lots of questions, and hopefully we can get a really good back and forth going, but there will be just a few slides to begin. So let's have a look at the this subtitle down here, if you like. What I want to focus on really is to explain and then illustrate with why this is an important topic, how credit risk-free assets, such as government bonds, can still lead to substantial losses. And this is a problem as a result of the activities of central banks in, well, actually most of the last 15 plus years, more or less going all the way back to the 08 crisis. We have a situation where central banks and other big investment firms have been losing significant amounts of money because of the long-term government bonds that they have been holding, and that they are selling them and then realizing losses. This is, in general terms, within the field of risk, called duration risk. So let me make the point really again. So you can see there, I've got the logos of three of the biggest central banks in the world: the US Federal Reserve, the ECB, Bank of England. And let's go through the key points. So when these banks, these large central banks, buy their own government bonds, which they have been doing in very, very sizable amounts, they do not face any credit risk, because it's not really feasible to think that any one of those countries listed in the banks there, or even most major banks, central banks around the world, the governments are going to default on them. There's no credit risk attached to them. However, if, and this has been the case, if these large central banks start to sell the bonds that they've been acquiring before they mature, I'll come back to this point a bit later, they can face very significant market losses. Just to give an example, the Bank of England here, and as Taya mentioned, I've done a lot of training and consulting work actually with the Bank of England over the last 5 years. It's estimated the Bank of England has already realized losses of more than £100 billion. And various estimates have suggested over the next year or two, this could even rise to 150 billion. There seems to be a bit of a typo there. On the other hand, the Federal Reserve in the United States, their central bank, has also incurred losses of more than $200 billion from the program known as quantitative tightening, or QT, which is where the Fed has been selling long-term government bonds back into the market. Now, this is not just a problem faced by the central banks. I want to refer specifically to another really quite key critical incident that occurred back in March of 2023. This was the collapse of Silicon Valley Bank in California. And as I will suggest, if you look at the circumstances and read around what happened to this bank, it essentially is a case study in how a bank totally mismanaged interest rate risk, duration risk. Just to kind of summarize quickly, this bank had a very large portfolio of long duration US Treasury bonds, which were being acquired when interest rates were extraordinarily low, back in the COVID period, for example. And then as interest rates began to increase, which they had to, for example, to deal with inflation issues, the mark-to-market value of the securities that SVB was holding dropped rapidly. To take a striking example, a 30-year US Treasury bond, so no credit risk, as I said, with an annual coupon, that's the amount of interest effectively that the Treasury is paying out on this bond, of only 1.25%, which was sold by the Treasury back in May of 2020. So we're right in the heart of the COVID pandemic. And it's a 30-year bond, so it matures in 2050, so it still has 25 more years to run, has today a mark-to-market value of less than 50% of its $100 par value. And this can actually be seen on the next slide. I'll come to that in a moment. But what I'd like to do now, so we can get a bit of interaction going with this, is pose this question. You can see it on the screen. And this will actually now appear for you as a poll. There'll be a polling exercise that hopefully will be triggered now. I can't see that myself, but maybe some of you can. Anyway, I'll read out the question. And as you can see, are you confident that the bank regulators have fully digested the implications of the collapse of SVB? Or do you think another similar episode lies around the corner? So here are the choices. The question is obviously no right answer to this. It's simply a matter of what you believe or your opinion. So you have a choice between lessons have been learned and the supervisory changes have been brought into effect to mitigate future similar incidents. The second possibility is, well, Silicon Valley Bank was such an unusual bank, and admittedly it was, that it doesn't really have any systemic implications. Or the third possibility or choice you have is tough questions have not been addressed based on what went wrong for SVB, and another similar bank run will almost certainly occur. So you can see those choices up on the screen. You know how to vote, I think. So I'll give you a moment or two to make up your mind as to which of those three choices corresponds with your feeling or opinion about this. All right. Okay, well, that's very interesting. That's perhaps a little bit more surprising than I actually thought. So we have only one person, I believe, thought that the lessons have been learned and the regulators are on top of it. Two people believe that essentially SVB was so unusual, it doesn't really have any systemic implications. 14 out of the people voting suggested that, in fact, there might well be further trouble ahead because, and my own view is that number three, I agree, is very much the way I would vote on this, because I don't believe that the regulators have addressed some of the problems that arose with Silicon Valley Bank. It was an unusual bank, but on the other hand, the one thing that I've, in the various training episodes or various training that I've been involved in since this, the one thing that clearly comes out in this discussion is that this is a bank run, or was a bank run, of a very different kind to the more traditional bank runs, where people would line up outside a branch of a bank to go in and withdraw their deposits if they felt nervous. What happened to SVB, and what could increasingly happen in banks all over the world, is you don't need to go and stand outside a bank waiting for it to open to withdraw your deposits nowadays. You can simply use a few mouse clicks. You go online, a few mouse clicks, and your money has gone. And just to give you a rather staggering statistic, back in 23, when that all happened, it is estimated that $50 billion of deposits were withdrawn in about 2-3 hours after it became obvious that there was a serious problem at SVB. So we need to rethink the idea of a bank run. It's not the old kind of classic textbook example of people out waiting outside to get their money out. A few mouse clicks will actually do the job. Let me move on a little bit more. As I say, we aren't going to spend too long in. I just want to illustrate the point I made a moment ago. So as of very recently, when I did this, I think it was on Friday of last week, let's take this, which comes from the Wall Street Journal. So here we can see that bond that I referenced a moment ago. This is a bond which matures in 2050. So in other words, still has 25 years to run. There's the coupon on it. And in order for this bond to be priced to yield, which is what happens in the markets on a day-to-day basis, that yield there, 4.9%, the bid and the ask, in other words, what you would basically realize if you sold that bond last Friday, is below $50. So in fact, you are going to lose 50% of the face value, par value of this bond, even though there is zero credit risk attached to that. And just to finalize, 2 more slides and then we can move on. I want to show you a couple of examples. Now, this is an extraordinary example. This is a bond, a government bond issued by Austria, which of course is part of the European Union. So it's a euro-denominated bond. It was sold during at the beginning of the COVID pandemic. It is a 100-year bond. So this has still 95 years to run. And as can be seen, again, I captured this just on the 27th of June, this bond is trading only at 32 euros. So once again, if you had bought this bond when it was issued back in, when was it actually issued? October 2020, you would have paid 100 euros for it. And in fact, the price even went higher because interest rates were at that point going down rather than up. But over the last 2, 3, 4 years, interest rates have moved much, much higher. Again, you would only get 32 euros if you sold it today. Now, people say things like, well, hold on a second, but if you hold this bond all the way through to maturity, which admittedly some big institutional investors like pension funds might do, then you wouldn't lose because the bond would redeem in 2120 for $100, 100 euros. But then you have to ask the question, what will be the purchasing power of 100 euros in 95 years' time? And I think you can probably agree that it will be a hell of a lot, or considerably lower than it is today. And one final example, this actually is a gilt issued here by the UK government. So yet again, no credit risk. This doesn't mature until 2061. Once again, would have been issued at par, £100 in this case. And as of when this was captured just the other day, this gilt would only have realized £26. Massive loss, 75% drop in the value of that particular bond. Now, another quick question for you, now that we've established some contacts, and then we'd like to open this up to a bigger discussion. Let's say somebody's thinking about their own personal investment portfolio, managing their own assets, their own personal wealth, if you wish. What percentage do you think should be allocated to owning long-term government bonds. As I say, just recall that many major institutional investors do hold huge amounts of such bonds. Um, Now, what do you believe would be a prudent or wise allocation to such bonds? So you've got three choices there. You see them on the screen. Once again, you have the opportunity to vote in the poll. All right, so we have quite an interesting breakdown here now. About 25% of the people who voted believe it should be 25%. Um, um, Trying to see what that is. No, I'm sorry, I misread that. It's 17% of the people who voted said 25%, the first choice. Half of you believe it should be 10%, and a third of you believe it should only, well, effectively be nothing, 0%. So that's quite an interesting result as well. Now, let me just move to one final slide. If you like, I can just plug this for myself. If you do find this kind of information interesting, and if you are somebody that is looking to get a professional training in the world of finance, either you already work in that area or think you're moving into that area, there's a list of training programs that I am running over the remainder of this year. You can see some courses held, public courses held in London, and you can see some digital learning courses where, if you wish, you can sign on to the at the IFF website. You can sign on and you can undertake the courses, which actually lead to a postgraduate certificate awarded by, that's effectively almost like a master's degree, awarded by the University of Middlesex here in London. And so can I now maybe remind you that this is a great opportunity to post something on the chat in the Q&A, or if you have a question. And I'm going to basically now stop sharing the slides because I'm going to open it up really for a much more oh, we actually have a final poll here. Would you like to be contacted about Clive's upcoming courses? So it's a very simple yes, no answer. I'll wait for that to go and I'll actually stop sharing my slides.
Well, in the meantime, just want to say thank you, Clive, for your time and the valuable insight into the remarkable things that are happening at the moment. We should still have a little time for questions. So one has come in already, Clive, if you're happy to get started. Someone's asked, how does the duration trap issue affect my own personal well-being? Does it, for example, affect my own pension?
Yeah, that is a very good and very pertinent question. I'm glad somebody asked that. Yeah, because what, let me, as I say, let's sort of broaden it out a bit and open it up a bit. Sometimes this topic that I've just been going through with you, and I've only really scratched the surface, can appear somewhat technical, theoretical, abstract. It doesn't really affect me, it doesn't really affect my life. But let me give you a concrete example as to how it could affect your own personal well-being. I'm sure many, if not all, of the people on this call would have some kind of pension arrangements. Maybe you invest your own, maybe you invest your own funds in building a pension of your own, or you're subject to an employer-based pension where they're providing effectively an income for you in your retirement. Now, I know quite a bit about the pension fund industry. I do quite a bit of work in that area. The pension funds, especially say here in the UK, United States, whatever, and throughout the world really, one of the biggest holdings, the major allocation that they make in terms of owning assets that generate an income, which then can be accumulated over years to then provide everybody with a pension when they do retire. One of their biggest holdings is long-term government bonds. And it's a UK pension fund would own gilts, UK government bonds. It would own probably some Treasury bonds. It could even own some, say, European government bonds, and likewise pension funds in other parts of the world. Now, I think it's no exaggeration to say that some of the decisions that have been made by big pension fund managers in recent years is they've overcommitted to these long-term government bonds. Now, it's true that many of these pension funds might say, well, we're going to hold these things all the way through to maturity. But just to give you a simple example of how that didn't work out so well, we had a case here in the UK a couple of years ago, brought about by a rather chaotic and irresponsible decision made by the government at the time. And we had a prime minister who was only in office for a few weeks. And what happened was the gilt market, the UK government bond market, sold off very abruptly and dramatically, really, as a result of this ill-conceived budget that was released. And a couple of big pension funds, huge pension funds, were on the verge of bankruptcy. They had to be rescued by the UK Treasury or the Bank of England. Bank of England had to intervene in the market, start buying gilts to prop the market up. Otherwise, these funds might well have collapsed. And the other important point that I should make, which I didn't mention so far, is that because of the problems that I've been talking about, just recall the numbers, 150 billion pounds worth of losses that it's estimated the Bank of England might well incur over the next year or two as a result of selling these government bonds, and similar problems with the Fed and so on. And even bigger problems really in Japan is that the governments in these countries, say the UK government, the Japanese government, and even the Fed, or not the Fed, the Treasury, have said that they are going to dramatically wind down the issuance of long-term government bonds. The Japanese have said they're not going to issue any more, I think it's 30 or 40-year Japanese government bonds. They're stopped completely because a number of their big insurance companies have been losing very sizable amounts based on the logic that I've discovered. The UK government or Treasury have said that they aren't going to be releasing or issuing as many long-term government bonds. And likewise, the Federal Reserve, they've basically found that the investment market doesn't want these long-term bonds for the reason I've said. So then you stop and say, well, if that's the case, that surely now poses a new challenge for these governments. Already, all of them, ones I've just mentioned and others, are facing difficulties with their fiscal policy, in financing their deficits, etc. Now, if they can't issue these long-term bonds, or they decide it's not wise to, that's going to pose even more challenges to the governments and the various central banks and treasuries around the world as to how they're going to finance these deficits that they seem to kind of be incurring year after year. So, a very good question. Any other question?
Yes, there were a number of questions in the Q&A chat. Some of it you might have answered already, but let's just have a quick look at them. Will the problem of duration risk only materialize if the bonds are sold, or is it in fact that the bonds that have a low return, if market rates have increased, become drag on and return off the balance sheet? Sorry, I don't know if I've said that.
Yeah. No, I see the point on that question, and just to kind of go back to something I said a moment ago, if you take that very long-term Austrian bond, or even that was kind of quite exceptional, although other countries around the world did take advantage of the very low interest rate environment that we had during the pandemic to release lots of extremely long maturity bonds, long duration bonds, effectively, which had very low coupons on them, and then today are worth, as you saw, maybe 20, 30 cents on the dollar or on the euro. Now, if you do hold those bonds all the way through to maturity, there is a sense in which you don't realize a loss, because the way the bond market works, so in government bonds, no exception, is that the bonds ultimately do redeem. In other words, the investor gets paid back what the face value or the par value, as it's known, of the bond. So if it's a UK bond, it's £100. Of course, people own much larger amounts, but the way we talk about it in the bond market is it's £100 par, $100 par, €100 par. So you do get redeemed at the full par value at the end of the lifetime of the bond. But then you come up with another question, which is the one I posed a moment ago. Let's just take the gilt example. We had a 40-year gilt there. That doesn't mature until 2061. That's what, 36 years from now. And it will redeem at £100. But how much is a £100 going to be worth in 36 years' time? In other words, what's the purchasing power of a of £100 in 36 years in 2061? I mean, it's quite easy to do some fairly quick projections based on inflation rates, etc. That the purchasing power could be quite minimal. So, either way you look at it, you either sell the bond, especially if you have to, or if you're a central bank that's being kind of almost required to reduce its balance sheet, or for some other reason you sell the bond, then you do realize or crystallize the loss. You take what you can get by selling the bond into the secondary market at what they call the mark-to-market value on it, the price that people are willing to pay today. And we saw in the two examples I gave, we saw that in the Treasury market, that one particular bond, if you wanted to sell it today, it would only get $50 or not even. It's about $48 if you remember. So it is a very, and the other thing I should mention, which I didn't before, is that there's rather unusual circumstances here in the UK with regard to those losses that the Bank of England are beginning to realise, and that they will continue to realise as they continue with what they call their QT program, quantitative tightening, that when the decision was made back in 2008, a decision which was made by the UK government at the time and the Bank of England, it was decided, unusually, that the UK Treasury, effectively the public balance sheet, will cover in full losses incurred by the Bank of England if there were to be losses in the manner that they are arising. So this does not apply, strictly speaking, for the US central bank or the ECB, although that's another discussion that I don't think we have time for. But here in the United Kingdom, we've actually now added, or will be adding, £150 billion to our national debt, because the Treasury will cover those losses that the Bank of England has incurred. So that's a pretty staggering amount of money. That exceeds what the UK spends each year on education, defence, and actually, to be honest, it's another discussion again. We might probably not have time to deal into the fiscal woes of the United Kingdom. That's another story.
Kind of leads into a couple of other questions we've had, Clive,
Yes.
about sort of how, sort of slightly more global questions, how geopolitical tensions affect duration risk. And also someone else has asked, is there a way to understand why the US have refused to implement Basel 2016 and IRBB for the Pillar 2? So sort of a bit more about sort of the wider world, I guess.
Okay. Well, thank you for whoever asked those questions. Very good questions. Let me. There were two separate questions there, weren't there? So, how do geopolitical issues affect duration risk? Well, I guess there's a couple of points I'd make. First of all, as I pointed out in the earlier discussion, what we are not referring to here is credit risk. That needs to be made perfectly clear. The possibility of geopolitical conflicts turning into some outright default by a government, that isn't really the issue that this whole discussion has been about. It's not a credit risk issue. And even though perhaps we might see deteriorations in the credit worthiness or credit ratings of governments around the world, like the United States just recently suffered a downgrade and now is not a AAA credit. The UK government is probably close to a downgrade, and so on. So it's not a credit risk issue. To the extent that geopolitical conflict, and as we know, there's plenty of that going on right now, to the extent that that could then lead to further inflationary pressures in the world economy. I mean, it's obviously, well, we just don't know. But if we do have some flare up again in the Middle East, and the price of crude oil jumps quite significantly, which it could well do, then that fact alone will lead to an increase in inflation around the world. The developed nations, or all nations, faced with much higher crude prices, that's going to translate into higher inflation. That's going to make it less easy for central banks to reduce interest rates, which they seem to be on that kind of path now. The Federal Reserve is holding its ground at the moment because they're concerned about inflationary pressures and so on. And if one of these geopolitical conflicts spills over into a significant increase in crude prices or other commodity prices for that matter, that would not be supportive of interest rate cuts. It could even lead to even higher rates of interest to deal with another surge in inflation. That would then translate out into the markets in terms of higher yields on long-term bonds. Those yields that I talked about. Do you remember I showed that example from literally last Friday, I think it was, that the 30-year US Treasury had to be priced to yield 4.9%, because essentially that's what the yield on a currently issued 30-year Treasury would be. So in order for that bond issue with a 1.25% coupon on it back in 2020, in order for that to compete with, in order for investors to want to buy that bond, the 1.25% coupon, versus buying a brand new 30-year Treasury, then the price of that bond has to go down to whatever it was, $48. That is the key to understanding duration risk, is to think about it like this. If you are an institutional investor, any number of banks, pension funds, whatever, and you're faced with the possibility of buying a bond issued by the Treasury back in 2020, when we had rock bottom interest rates because of COVID. Short-term rates were effectively zero. So the US Treasury was able to get away with issuing a 30-year bond with only 1.25% interest rate on it. All right, that bond is still sitting out there. Many of them, billions of dollars of such bonds, were issued by the Treasury back then. It's the same issue that SVB faced. They bought up huge amounts of such bonds. But then, as an institutional investor, you say, well, should I buy that bond, still has 5 more or 25 more years to run, or should I buy a brand new Treasury, shiny new 30-year Treasury, just published or just auctioned by the Treasury, which has basically a 5% coupon on it? Well, it's a no-brainer, isn't it? You're going to buy the brand new Treasury, and the only way that somebody could be persuaded or induced to buy the bond with the 1.25% coupon on it is that it needs to be heavily discounted. This is what the mark-to-market idea is all about. In order for the bond to be priced to yield, that's the key idea, priced to yield. In order for that 1.25% bond to be priced to yield effectively 5%, which is what the currently issued 30-year bonds are yielding, you have to discount it. You have to discount it all the way back down to what, $47, $48. Now, the second question, if I recall, had to do with a fairly technical question in the world of banking regulation. And again, very interesting question. I'm not sure that we have the time or the context to cover it, but it is a very interesting question. Let me see if I can deal with it fairly quickly now. In the world of banking, and I'm sure some of the people on this call are in banking, which is in the world of banking, there are different ways of valuing your assets, your exposures in the market. Now, here, for example, and most of Europe, we basically value holdings of bonds, government bonds, or corporate bonds, more or less at their market value. In the United States, there's a slightly different approach, which is that they get the opportunity to select or elect a certain number of the bonds that they hold as effectively what they call hold to maturity bonds, not available for sale or not for trading book purposes. And then that enables these banks, and we are talking about the world's biggest banks here, you know, the JP Morgans and the Citigroup and the Goldmans and so on, hold literally hundreds of billions, if not more, trillions of dollars of US Treasury bonds. Now, if you are able to say, well, this bond we're going to hold all the way through to maturity, you don't have to mark it to the market. So you don't have to recognize the deterioration, big deterioration in the pricing of the bond, the $50 example I just gave before, the $48 that 30-year bond is worth right now. But then, of course, you have two things to think about. First of all, you have the Silicon Valley Bank problem, which was where there was a run on the bank. The depositors, the smart depositors, realized that essentially the bank was upside down, and they started a run on the bank. So SVB thought that it could maybe hold these long-term treasuries right the way through to maturity, but then $50 billion disappeared in a couple of hours. So they started selling those bonds to try to meet those depositor withdrawals. That obviously didn't work. And in fact, the bank was eventually closed down. But the point, I think the question the person was asking is, in the regulatory world, we have the Basel framework, which has been more or less implemented globally, in some differences in different parts of the world, what have you. But one big difference between, let's say, the way that Basel, the regulatory framework has been implemented in Europe, I'm being somewhat general here, broadly speaking, is that there is a focus on what would be held in the banking book. That's the book that's not the trading book. That's the book that essentially you might want to argue doesn't need to be marked to market. But then the regulators, the Basel Committee, decided that they would come up with a brand new, some years ago now, a new test for banks, really, which is what the questioner was asking, what's known as the interest rate risk in the banking book. Now, if you apply that in the way that Basel intended, then you do have to face up to the problem that even if you've got bonds that say JPM and Goldman and Citigroup and so on are holding, but they say, well, we don't need to mark them because we're going to hold them right the way through to maturity, then the Basel Committee said, no, you still have to essentially do a kind of stress test on those bonds to figure out what they would be worth in under different interest rate scenarios. This is getting rather technical, I must say. But the United States basically have never really embraced that idea. I think they do apply some kind of testing on it. Well, I know they do for some of their very big banks, but they wouldn't have applied that, for example, in the case of SVB. You see, there again, this goes back to the question I asked earlier. Do we believe that the regulators have fully digested what went wrong at Silicon Valley Bank? For several reasons specific to the United States, which of course is the world's banking center in many ways, their regulations don't bite at the level where SVB was. SVB was not, it had a balance sheet of about 250 billion, so it was a sizable bank, but it was not in the big leagues. It wasn't one of the it was below the threshold. I think the threshold is 750 billion. If you were below that threshold, which SVB was, then you're not subject to many of the regulatory stress testing that would apply, say, here or in other parts of the world. So SVB basically got a free pass. They didn't have to do the IRRBB test, and they didn't even have to do the standard stress test. And they weren't also subject to another kind of testing in the banking world, which some of the people on the call will be familiar with, having to do with the liquidity risk, the liquidity coverage ratio. And that in itself could lead to a much bigger discussion about why I believe the SVB episode has not been fully addressed. And the other point to make, and again, I'm going to be a bit more technical, after SVB did collapse, the Treasury and the Fed decided that they would accept as collateral long-term US treasuries at full par value. I'm not sure whether that's still in effect. I believe it might be. So a bank, let's say then, after SVB collapsed and SVB was selling these bonds and recognizing these huge losses, another bank afterwards could say, okay, well, I'll take my treasury to the Fed and do essentially use it as collateral on a loan, and I get the benefit of a full $100 par value valuation by the Fed when they're providing funding on that loan, on that bond. That was a bit technical, that last bit. Any other questions?
Well, actually, there's still quite a lot of questions, so I don't think we're going to have time to run through them all. But we can answer them offline. So what we will do is get back to everyone individually and answer them offline. I mean, we could squeeze in one more with a small answer, maybe. But there's one here saying how the country's sovereign risk rating has impacted the government bond returns.
Well, in a way, that goes back to an earlier question and something that we did talk about. And we need to be very careful, excuse me, we need to be very careful in distinguishing between credit risk and market risk. You know, in all the training that I do, and I do a lot of training on credit risk for banks and other financial firms and so on, credit risk is much more of an issue, say, for corporate bonds. If you're a company and you want to raise capital in the capital markets and you issue a corporate bond, the credit risk issue then becomes quite critical. I mean, that's why credit ratings are a good guide, not maybe an infallible guide, but a good guide as to pricing of bonds after they've been issued in the secondary market and what have you. And, you know, if a company gets downgraded by one of the agencies like Moody's or what have you, that bond will then lose a lot of its value, especially, you know, if the rating moves down into sub-investment grade territory. But with regard to sovereigns, governments, credit ratings do not really impact the pricing of bonds to anything like the extent that market risk or interest rate risk does. And that's really, in many ways, one of the underlying themes of this whole discussion is that what we are talking about with government bonds is, even though they are deemed to be safe, we hope we don't wake up one morning and find out that the US government can't pay its bills and can't pay off its debt. Likewise, say for UK investors or people anywhere, you don't want to wake up and find out that your government's defaulted. And it's unlikely, theoretically could happen, that these governments are going to fail. So there's no real credit risk in owning these bonds. But as I think the discussion we've been having shows, that's only half the story. In fact, probably not even half the story. The bigger problem, of course, is the duration risk issue.
I think we probably have to wrap it up there, Clive. I'll say thank you again for your time. Like I said, we will get back to everyone on the questions and answers. We'll share them with everyone on the call. And obviously, there's still a lot to talk about. And Clive will cover all this on the courses coming up. So, you know, if anyone is interested, please get in touch. Many thanks, everyone, for your time.
Yeah, if I could just echo that as well. Thank you all very much for attending. Hope you found it interesting and worthwhile. And as Taya said, I'll have a look at the questions, the ones we didn't get around to answering, see if I can do my best in giving specific answers where you know, to the people who've asked.
Great. Thanks, Clive.
Okay. Goodbye, everybody.
Thanks. Bye, everybody.
What if you and your team can be even more? Even more informed, competitive, accomplished, even more successful, with programs designed to inspire and empower everyone to become even more. Introducing Informa Connect Academy. With hundreds of global, digital, and in-person training courses, led by world-renowned industry experts. Reimagining learning experiences for even more unlocked potential. Informa Connect Academy, available at informaconnect.com/academy.